Here we are again, staring at the Bitcoin chart after it soared past $124,500. It's a number that just a few years ago would have seemed like pure science fiction, but now, it's our reality. The crypto world watched in awe as Bitcoin shattered expectations, breaking through resistance levels and leaving skeptics speechless. Social media exploded with excitement, and headlines everywhere declared a new era for digital assets. For a brief moment, it felt like the sky was the limit, but just as quickly as the euphoria set in, reality came crashing down. Bitcoin tumbled to $112,000 almost overnight, wiping out billions in market value and sending shockwaves through the entire crypto community. The sudden drop left traders scrambling, and many investors questioning their strategies. The rally was wild, but the correction was even wilder, shaking out weak hands and making even die-hard hodlers nervous. Social feeds filled with panic and speculation, as people wondered if this was just another bump in the road or the start of something much bigger. The emotional roller coaster was real, and the volatility reminded everyone just how unpredictable this market can be. Now, the market's at a crossroads. Investors and analysts are debating whether this is just a healthy cooldown before another surge, or the beginning of a deeper, more prolonged bear market. Some point to historical patterns, noting that Bitcoin has always bounced back stronger after corrections. Others warn that macroeconomic headwinds and regulatory uncertainty could keep prices suppressed for months to come. The stakes are high, and the next move could set the tone for the rest of the year. Every decision made now, whether to buy, sell, or hold, could have major consequences for portfolios and for the broader crypto landscape. The world is watching, and every headline, every tweet, and every chart movement is being analyzed for clues about what comes next. So, is this a golden buying opportunity, a rare chance to get in before the next leg up? Or is it a classic bull trap, luring in hopeful investors before an even bigger drop? The uncertainty is palpable, and the pressure is on to make the right call. To answer that, we need to dig into the data. Profit-taking by whales, institutional moves, new regulations on the horizon, and the broader economic climate. We'll look at on-chain metrics, trading volumes, and sentiment indicators to get a clearer picture. Only by understanding the bigger picture can we hope to make sense of these wild swings. Let's break it all down, step by step, and see what the numbers and the experts are really telling us about where Bitcoin could be headed next. Smash the like button and let's get started on this deep dive into the $124,000 question. The main reason for the drop: classic profit-taking. Investors who had been holding Bitcoin for a long time saw the recent highs as an opportunity to lock in their gains. This is a common behavior in any financial market, not just cryptocurrencies. After a parabolic run, investors sitting on huge gains cashed out, totally normal in any market cycle. When prices skyrocket, it's natural for people to want to take some money off the table. This selling pressure can cause prices to drop quickly. But it wasn't just retail. Leveraged traders got wiped out as the price fell, triggering a cascade of liquidations that accelerated the drop. Leveraged trading allows investors to borrow money to increase their positions, but it also increases risk. When prices fall, these traders are forced to sell, creating a domino effect. Corrections like this are painful but necessary. They shake out excess greed and reset the market. It's a way to bring balance back to the market, removing the speculative froth and allowing for more sustainable growth in the future. The run-up was fueled by euphoria, and the drop was a reality check. When prices rise too quickly, it often leads to irrational exuberance. The correction serves as a reminder that prices can't go up forever, and that the market needs to find a more realistic valuation. Volatility is the price you pay for Bitcoin's upside. The potential for high returns comes with the risk of significant price swings. Investors need to be prepared for this kind of volatility if they want to participate in the cryptocurrency market. This doesn't mean the bull run is over. These sharp pullbacks are often just pit stops. In a long-term uptrend, it's common to see short-term corrections. These pullbacks can actually be healthy, providing opportunities for new investors to enter the market at lower prices. The key is understanding that corrections are healthy, not a sign of doom. They help to prevent bubbles from forming and ensure that the market grows in a more sustainable way. Long-term investors should view these corrections as opportunities rather than threats. The market simply needed to cool off and find a more reasonable valuation. After a period of rapid growth, it's natural for the market to take a breather. This cooling off period allows for a more measured and thoughtful approach to investing. For now, the shock has passed, but the volatility isn't going anywhere. Investors should be prepared for more ups and downs in the future. The key is to stay informed and make decisions based on a long-term perspective rather than short-term market movements. Let's see what the big players are doing. Institutional investors and hedge funds have a significant impact on the market. Their actions can provide valuable insights into where the market might be headed next. By paying attention to their moves, individual investors can make more informed decisions. One of the biggest drivers of this bull run has been massive inflows into Bitcoin spot ETFs. Wall Street money poured in, pushing prices to new highs. But as soon as the price faltered, ETF inflows slowed, and even turned negative on some days. This shift signals that institutions are getting cautious, waiting for clarity before buying more. ETF flow data is crucial. If inflows pick up, it's bullish. If outflows continue, expect more consolidation or downside. For now, the institutional engine has stalled, and the market feels it. Watch ETF flows closely. They're the clearest window into big money sentiment. Let's talk about another source of uncertainty: regulation. Just as the market was digesting the correction, regulatory fears returned. The SEC's investigation into Alt-5 Sigma, linked to a Trump-associated crypto project, spooked investors. Regulatory uncertainty always rattles crypto, especially when politics are involved. Even if this probe doesn't directly impact Bitcoin, it adds to the risk narrative and keeps big money cautious. The market hates uncertainty, especially political drama. Until there's more regulatory clarity, this will remain a headwind. But regulation isn't the only macro risk right now. All eyes are on the Federal Reserve's Jackson Hole Symposium. Investors are desperate for clues about interest rates. Will Powell confirm a September rate cut, or hint at delays? Lower rates would be rocket fuel for Bitcoin. A hawkish surprise could trigger a sharp sell-off. The market is frozen, waiting for Powell's words. Traders are reducing risk, unwilling to bet big before this pivotal event. Bitcoin's next move is tied to what's said in Wyoming. A dovish signal could send us soaring, a hawkish one could mean more pain. Until then, expect nervous sideways action. Let's look at the technicals. Support and resistance are the battlegrounds of any market. Right now, Bitcoin's key support is $112,000, $113,000, a level where buyers have stepped in. If that floor holds, it's bullish. If it breaks, the next support is $105,000, $107,000. Resistance sits at $117,000, $119,000. A break above $119,000 would signal bulls are back in control. These levels matter because so many traders watch them, they become self-fulfilling. Support and resistance aren't magic, but they reveal where buyers and sellers are fighting hardest. Watch these zones for clues about the next big move. If support holds and resistance breaks, we could retest the all-time high. If not, brace for more downside. Now let's check the indicators. The 200-day simple moving average is the line in the sand for long-term investors. Bitcoin is still trading above it, so the primary uptrend remains intact. If we break below, that's a major red flag. Short-term, the RSI dipped into oversold territory after the crash, often a sign of a potential bounce. The recent rebound from $112,000 lines up with this oversold signal. But remember, an oversold RSI doesn't guarantee a strong rally. It's just one piece of the puzzle. Combined with strong support, it suggests a temporary bottom may be forming. Keep an eye on these indicators for confirmation. Now, what should traders and investors actually do? For short-term traders, patience is absolutely essential. Don't fall into the trap of trying to catch the exact bottom or predict every twist and turn. The crypto market is notoriously volatile, and acting on impulse can lead to costly mistakes. Instead, take a step back and let the market show its hand before making your move. Wait for confirmation. Look for a decisive break above the $119,000 resistance level, and pay close attention to technical indicators like the RSI turning upward. These signals can help you avoid false starts and give you more confidence in your trades. Watch for aggressive buying to return before jumping in. Volume spikes and strong momentum are often the first signs that a new trend is taking shape. Don't be afraid to wait for the market to confirm its direction. Sometimes, sitting on your hands is the best trade you can make. For long-term investors, it's important to focus on the big picture and not get shaken out by short-term volatility. Remember, Bitcoin's journey has always been marked by sharp corrections followed by strong recoveries. As long as Bitcoin stays above the 200-day moving average, the bull thesis remains intact. This key technical level has historically acted as a line in the sand for major trends, and staying above it suggests that the long-term uptrend is still in play. Corrections are not just setbacks, they're opportunities to dollar-cost average and build your position over time, but always remember to manage your risk carefully. Set stop losses, know your exit points, and never let emotions dictate your decisions. Never invest more than you can afford to lose, and keep your portfolio diversified across different asset classes. This approach helps protect you from unexpected shocks and smooths out the ride during turbulent times. The long-term outlook for Bitcoin and crypto remains optimistic, but it's crucial to stay aware of the risks, especially those coming from the Federal Reserve's policy decisions and potential regulatory changes. These factors can have a major impact on price and sentiment. Hold on, manage your risk, and trust the trend as long as the data supports it. Be ready to adapt if the situation changes, but don't let fear or hype drive your actions. The next few days will be critical for both traders and investors. Stay alert, stick to your plan, and remember, success in crypto comes from discipline, not luck. Bitcoin is at a crossroads, caught between bullish optimism and bearish caution. Bears point to slowing ETF inflows, regulatory drama, and Fed uncertainty. Bulls see a healthy reset, strong support, and an intact long-term uptrend. My take? Cautious optimism. The long-term fundamentals haven't changed, but the short-term is murky. Watch $112,000 support, $119,000 resistance, ETF flows, and Powell's speech. The market's next move will be decisive, so stay alert, manage risk, and be ready to act. Thanks for watching. Stay safe out there.